Well, Grant, Australian industry, particularly manufacturers, are getting quite anxious about gas supplies in the future. Have they got something to worry about?
So I think it's factually true to say that gas prices will go up at what we call an ex-plant level. So you buy gas from a gas producer, ex-plant, the price of that gas will go up. Depending on what sort of user you are, whether you're a customer in a house or a small business or a large customer,
fertiliser perhaps.
Yeah, it'll feel quite different because the delivered cost of energy to households, of course, has all those network costs embedded in it, and I don't think you'll feel much of a change at that level. It will go up, but not all that much. But it's right to say that if you're a wholesale buyer of gas for, say, power generation or a very large, it's used as a feedstock or like a fertiliser plant, for example, you'll see quite a significant increase.
So what's the clearing price of gas? To get the supplies that industry in particular requires, what will they have to pay?
So the general belief between, say, 2014, 15, 16, as the LNG projects in Queensland come online, that prices will move somewhere near export parity, somewhere in that $7, $8 range is a number that people fairly typically talk about.
And how does that compare with what it is now?
You would have said it's already moved. Wholesale prices have already moved, but compared to, say, 2 years ago, so to say give you a 5-year view, you would have said, say, $3.50 to $4 2 years ago. So prices have already moved.
Will double.
So over about a 5-year period, the wholesale cost of energy, that is the ex-plant cost, will about double.
Now, if the ex-plant cost doubles, what will that do to the supply? Well, first of all, have we got a shortage of supply?
Right. I think it's a very good place to start the discussion, actually. So if we go back to the mid-1990s, and it's important to do that for one reason, that is in the mid-1990s, we only talked about conventional gas, our main sources of gas in Eastern Australia were the Cooper Basin, the Gippsland Basin. There's been no major discoveries of gas in those basins in the last 15 or 20 years, or any other basin for that matter, conventional. So gas it wasn't in decline in a production sense, but in a reserve sense it was clear in the mid-90s Eastern Australian gas was in decline. And some of you and some of your listeners might recall that in fact even in the early 2000s we were going to bring gas down from New Guinea because we didn't have enough gas here. Now I can assure you that the key point there is that we would be paying those prices for our gas today if we hadn't seen that the right response occurred to those higher prices, which of course people without risk money explored, particularly for CSG, and the resources expanded dramatically in terms of the return available through gas price. So we did not have a supply problem. People will not run out of gas. There will not be a lack of gas in Eastern Australia for anyone, anywhere. But we will see prices move to the true value of that gas in the same way as we pay the international price for petrol or for iron ore or any other commodity that Australia produces.
Grant, there's some conflicting strands to the story, aren't there? And the conventional view is that as your plants in Gladstone come on stream, the domestic price will rise because of the access to the international price. But equally, there's a view that the US shale gas revolution is going to push some of that gas into our markets, putting downward pressure on the international price and therefore on domestic prices. How do you see that playing out?
Yeah, there's been a lot of discussion about that. The US clearly has got a bountiful situation in respect of gas through much the same phenomena. Their prices were very high. People explored, figured out how to fracture shales. Now they've got an enormous amount of gas and the price has fallen. They will be exporting LNG. A number of plants have already been approved for export and some more almost certainly will be. The general view is that the volume of LNG that will come out of the US will not fundamentally disturb particularly the Pacific markets, the Asia Pacific markets, in terms of volume out of US versus size of market. And so that's the generally held view in the industry. So we're not expecting that supply of gas from the US will create if you like, a step change or a huge reduction in the net back price of gas to Australia or any other producer in the region for that matter.
Even if the starting point's Henry Hub pricing?
So here's a very quick analysis. The opportunity in the US isn't that the gas at Henry Hub is cheap, because there's a certain amount of gas in Australia you can produce at the same price. The opportunity in the US is that there are stranded import facilities with storage tanks and wharves that are now stranded because they're not importing. And therefore, if you turn them around, the capital cost of producing LNG is less by the amount that you can recycle those facilities. So the disruptive opportunity in the US is those stranded facilities being turned around. Now, when we look at those facilities, they still have to have LNG plants built in front of them. And those LNG plants are just the same as it would cost to build an LNG plant in many other places in the world, maybe a little bit cheaper in the Gulf Coast of the US, and therefore still billions and billions of dollars. So the disruptive event isn't the gas, because there's lots of gas in Australia that can be economic at a price as well. It was the ability to turn those stranded import facilities around at a lower capital cost and produce the LNG more cheaply. And that opportunity is limited. It's not limited by the gas resource, it's limited by the number of export facilities that could be economically turned around.